Have you seen the news that Japan is dumping U.S. Treasuries? It's a huge deal, and it could be the catalyst that sends Bitcoin to the moon. Here's how it all connects. First, is it true? Yes. For the past 2 years, Japanese institutions, who were once the biggest foreign buyers of U.S. debt, have been selling. Why? It comes down to hedging costs. A Japanese investor buying a U.S. Treasury gets about a 4 to 5% yield. But the cost to hedge against currency fluctuations between the dollar and the yen is now 5 to 6%. That means their net yield is zero, or even negative. So, they're selling. This isn't just a blip. It's a major structural shift. So what happens when a massive buyer like Japan walks away from the U.S. debt market? There are really only 3 possibilities. Option 1. Interest rates have to rise. Less demand means the U.S. has to offer a higher yield to attract new buyers. In theory, this makes sense. But there's a massive problem. The U.S. government simply cannot afford higher interest rates. The cost of servicing its debt already exceeds the entire military budget. So, this solution can't last for long. Option 2. Domestic buyers step in. And this is happening to some extent. U.S. banks, money market funds, and ETFs are buying up some of these treasuries. But they just don't have the capacity to absorb the trillions of dollars of debt the U.S. issues every single year. It's like trying to fill an ocean with a garden hose. This leads us to the real endgame. Option 3. The Federal Reserve steps in. When foreign and domestic buyers can't absorb the debt, the Fed becomes the buyer of last resort. This means they turn on the money printer and start quantitative easing, or QE. They print new dollars to buy U.S. debt, which artificially suppresses interest rates and weakens the dollar. When this happens, risk assets like stocks, gold, and especially Bitcoin tend to explode upward. We saw this playbook run in 2008, 2012, and again in 2020. History tells us it will happen again. But what if the economy is slowing down at the same time that nobody wants use bonds? This is the nightmare scenario for central banks, known as a stagflationary debt spiral. You get slow growth, massive debt, and rising interest rates all at once. The government can't fund itself, interest payments skyrocket, and the economy weakens while inflation stays high. This forces the Fed into a corner where it has to choose between saving the U.S. dollar or saving the government and its bond market. And let's be honest, they will always choose to save the government. This means QE isn't just an option. It's inevitable. The system cannot survive without the Fed printing money to control interest rates and devaluing the dollar to manage the debt load. This is the only path left, and the markets are starting to realize it. Now, some people ask if stable coins like USDT could save the day. The answer is a hard no. Stable coins don't fix the treasury market. They exist because of it. USDT holds UST bills as reserves and depends entirely on the stability of the U.S. financial system. If the treasury market gets shaky, stablecoins get shaky. This would likely cause a flight into assets outside the system, like Bitcoin. So let's map out the real sequence of events. Step 1. Foreign demand for treasuries falls, just like we're seeing with Japan. Step 2. Yields start to rise to attract new buyers. Step 3. The U.S. government can't afford the higher interest payments. Step 4. The markets start to panic. Step 5. The Fed is forced to intervene with massive QE. Step 6. The dollar weakens and inflation rises. And finally, Step 7. Hard assets like gold, commodities, and Bitcoin go parabolic. This is where most people get it wrong about Bitcoin. Bitcoin doesn't necessarily benefit from a recession. It benefits from liquidity expansion. When the Fed is not printing money, Bitcoin tends to fall or trade sideways. But the moment QE begins, Bitcoin explodes. Japan's selling of treasuries is pushing the U.S. closer and closer to that QE moment, which is incredibly bullish for Bitcoin. It all leads back to the same conclusion we keep seeing. Bitcoin is the ultimate safe haven for when the sovereign debt bubble finally breaks. Gold is the first step, but Bitcoin is the final destination. It has the potential to become the world's new reserve collateral asset, completely outside the control of any single government or central bank. Thanks for watching. If you found this breakdown helpful, make sure to like, subscribe, and hit that notification bell so you don't miss our next video. See you next time.